The way it works is I split it into cyclical yield, into defensive yield, into dividend champions. And the reason I do that is because, again, a lot of income funds, the perception is that they're just all kind of defensive and they'll just be in bond proxies. Well, actually, the way the market's changed because of the conditions I mentioned before with business disruption and the like, there are pockets of the markets in the cyclical space which are offering really, really good kind of income growth, sustainable income growth. So part of my skill set is to be able to tie in where we are in the cycle, which we talked about before, and what dividend strategy is applicable for where we are in the cycle. So if we look at some examples, so for cyclical yield, you normally want to be more heavily weighted towards that when you have bond yields rising and economies improving in a normal cycle. For defensive yield, you're more normally in that bucket when yields are falling, bond yields are falling, economic conditions are slowing, and that puts you in kind of sectors like A-REITs and consumer staples and utilities and the like. The cyclical side would have been more materials and financials and consumer discretionary. And then you have the dividend champions, which are good throughout all cycles. And they're ones that have just got really, really resilient business models, which can generate, great sales revenue, great margins, great revenue growth, great cash flow, and most importantly, great dividend growth, without too much influence happening from the economic cycle. And they're not easy to find, those stocks, but they are out there. And the compounding effect of income is what, really is the key focus. So when people look at valuations, some of these stocks may look expensive, but if you look at where the income generation has flown over the last, say, 4 or 5 years, it's been very, very powerful. And if I take a company like Aristocrat, which we hold in the portfolio, the compound dividend rate for that stock over the last 5 years is about 20% per annum. Now, it's not a high yielding stock optically, it's on about 2% yield, but the compounding effect of that is extraordinary over that time frame. And that's a case in point that I'd signal out as a business model which I think has got a great deal of longevity because of the nature of their business and their competitive advantage in gaming and in gaming software that I think that's sustainable. I mean, another one that you could put in that camp would be CSL, for example. Again, had a really good result recently, and that's a company which has delivered very, very decent compounding dividend growth. They're in a very, very unique position with their business model. Their competitors are struggling with regard to getting adequate plasma supply. So, look, their business structure looks really compelling, and that's long term. And they've got a great R&D program to continue that flows. That's another example of a stock which is not optically high from a dividend yield perspective, but it's just got this compounding effect that flows through.